so we can see what's going on with CPI and some other, let's just call it surprises. All right, so first let's take a look at the heat map this morning. VIX is still muted. Markets around the globe are moving higher in futures. Russell yesterday had a big surge. We're going to talk about that. A lot of micro cap plays are taking off from short covering. And then, of course, we have a lot of chop, but higher, grinding higher into the CPI print, which is tomorrow morning. Pre-market. I want to talk about that CPI in detail because there's both a macro and a micro component, which is, I think, really, really critical to position. And then, of course, see how the market reacts. But long story short, we still have a lot of chopping about, not only in the main indices, also volatility getting suppressed, but also oil and gas plays still chopping around. We don't really have a lot of follow through, maybe a spike here this morning in lumber, but that's not really compelling. We know what's going on with industrial metals like copper. They have been spiking higher, also steel, precious metals of gold and silver. This is in large part reaction, many feel to China reopening. I think it is absolutely the dollar. The dollar has fallen 11% in the past 2 months and a few days, and that is the reason for the season, with China stimulus causing this speculative bid, not only in demand for copper, industrial metals, precious metals, but also in the hedging, because we have commodities serve as inflationary, as inflation bets. Oil, not so much, which is actually, I think, a better representative. And it's also suppressed, as you know, from SPR releases, which is government release of strategic petroleum reserves. So we have government intervention tapping down the oil and gas plays, in addition to nat gas falling precipitously from a warmer weather in Europe. So this is definitely falling back into kind of its value area. We've talked about that. I'll bring those charts up in a little bit. We have the indices sideways holding their breath into CPI, which I have written about at length this morning. And then we have gold and silver and the rest likely waiting to see what's going to happen with the dollar even more. And we're going to talk about China, dollar, CPI, bonds, and trend trades, because Michael and I went through all of that yesterday. I have all those updated open positions, closed positions, and a watch list to size up some really great trading opportunities for the beginning of the year. All right, so let's kind of get into my piece that I am going to post right now, just because I think it's very important for both macro and micro. I don't have all of it written, but I think it's enough for now. So I'm going to hit send, and then we're going to go over it. Let's talk about CPI. And there's a big reason why we're going to talk about CPI, and hopefully you can read this more leisurely than this morning before the open. But I want to kind of skip right from the macro to the micro. JP Morgan has some CPI guesses for Thursday morning. Okay, so if we basically hit an inflation CPI print that is above 6.6%, the probability, this is the 15% probability, is that the market will see that as hot inflation and will trade down 2.5% to 3%. By the way, we don't know, right? But the point is, this is the estimated guess by JP Morgan on a hot CPI. If we trade in the 6.4 to 6.6%, right, this is kind of like in a sweet spot because consensus is 6.5%, then market will probably bounce about 1.5% to 2%. This is the highest probability. And then if we dump, we have a very soft inflation print below 6.4%. Then, oh, by the way, I said down. That means drop, means, did I say up? Anyway, you know what I'm saying. I wrote it here. I might have said it differently. We would fall 2.5%. If we're in line, we will rise 1.5% to 2%. And if we are much cooler in CPI, then the market could have a standard deviation move of like 3 to 3.5%. So these are the probabilities that they've put out there. So that's the macro, right? So folks that are positioned in short duration are going to be playing those odds. And one thing that Tiffany mentioned yesterday is that the gamma right now is such where folks have cheap calls, and you can basically buy a strangle or a straddle because gamma is quote unquote cheap, and you can make some kind of outsized moves. But as far as I'm concerned, this is like trading earnings, right? So earnings, you have an expected move, let's say of, this 2%, and anything above, right, is your standard deviation outlier that makes those directional calls and puts, outsized. But it's really, really, really a lotto. It really is a lotto. You don't really know. So that's for anyone who's short duration or who has swings on and they're worried about a similar repeat like what happened on November 10th when we had a massive gap up, right, on CPI cooling. And we did a massive gap up from the 9th to the 10th. We had a 7.5% one-day wonder in NASDAQ, right? So it gapped up and then it kept going. It was a 4 standard deviation move. Anyway, the point is it was dramatic, and folks are hoping for that type of move again. Not so much. I think last time we had it suppressed because FOMC was the following day. Remember that? So the last CPI print, we actually had a bit of a move higher, and then FOMC came in and Powell tapped that whole expectation down and we dumped. We actually topped and then we rolled over. Okay, so that was November, then that was December, and now we're going to get the January CPI tomorrow, and nothing after it to really slow down the directional move. So Powell's out of the way. Mary Daly came in with Bostic on Monday and said, Fed is steadfast, we're going to hike. We basically had Powell on Tuesday refuse to even discuss the monetary policy. So here's what we have right now for CPI, which I wanted to kind of summarize, and then you can go in and dig in and take a look at it. We're basically inflation turning deflationary as it relates to inflation expectations. So let me explain. We have a strong backdrop of durable goods falling month over month in prices. So inflation expectations for durable goods has proven with indicators, macro, economic indicators, that prices are falling from the peak, right? So we had the COVID lockdowns, supply chain, massive disruption, and input costs rose very strongly. And now they have been falling. And the proof is durable goods have continued to fall. Services have been very, very sticky. Wage demands have increased. Wages have increased. They have started to cool on a month over month, but they're still very sticky. So this is basically where we're at. After peaking at 9.1% in June of 2020, which aligned with my warnings, and you'll see in macro to micro, I kept talking about peak earnings, right? Peak used car prices, peak housing prices. So since then, the year-over-year CPI growth rate has fallen to 7.1% in November. Tomorrow's CPI consensus estimate is 6.5%. So that's a big drop, right? It's a big beat, or, in earnings parlay. So that is basically the focus is not just the headline, but the rate of growth from month over month. And that's where I want to spend the attention, because most aren't going to be thinking about that. But I think it's a really, really great observation. And I reference an article. Basically, the attention will be likely on this CPI growth rates that had been very, very strong from January to June in 2022 before they peaked, where month over month it was like a 1% increase. From July to November, the average has just been 0.1%. The result is that obviously annualized growth in CPI is falling. In fact, so much so that we're likely going to get a negative in December. That's his bet. More interesting to me, because we can already, see that the declining rate of growth in CPI is that money supply has been also falling precipitously lower. And that's very interesting from a macro standpoint. So I've got a chart in here to take a look at that. The deceleration in this money to growth has now turned negative for the first time in 60 years. And what are the assets tied to money supply growth and year-over-year rate of inflation, yields, as well as dollar, as well as commodities, the reflation trades, etc. So there's a lot that's going to be packed into this CPI. Even if it's just a little bit off from consensus, the market will have its reaction. But the bigger takeaway is that we have more evidence for this turning from inflationary to deflationary. Now, I still believe and contend that over a period of time, this is structural inflation. Wages will maintain. We're going to have waves of inflation. But right now, we're going to be front and center with the market facing a potential deflationary impulse. And they really haven't gotten that message yet. And that's my main point. Why have I been focused on this? Because I look at bonds, I look at yields, I look at dollar. I see dollar is not stabilizing so well. It looks like it's going to fall even further. I look at yields, and even though it's been a chop fest, I look at yields going, you know what? They look like they're going to continue to fall, and bonds get bid. The bigger risk basically is that the market is pricing in a Fed step down, a pause and a pivot, when they have refused. They've said no, right? Not just the Fed heads, but Powell himself has said, no, we've got nothing we're going to change because the risks are unacceptably high, for inflation. So now the bulls have to kind of look at this and go, oh, good, inflation is cooler, markets should rise, but the Fed is still tightening. Oh, no. So I just want to kind of emphasize this little bit about the CPI with its one-day wonder reaction to the market, and then bigger picture, this unattractive risk reward where equities start to price in potential deflationary impulse. And that's, I think, a bigger deal. So we have a unattractive risk reward. I've been talking about this expression, this phrase for weeks and weeks and weeks, right? So we also have this big, as you know, JP Morgan collar, which is their short, the 40-30 calls. And then they have a put spread, 3,600 by 30-40. This is actually, where they see the market hedge for Q1. So I'm looking at 3,600 by March. I think that's a baseline bet. That's a pretty good one. We ended, obviously, Q4 at 38.35, which also happened to be their long put. So unattractive risk reward, even as we push higher above 39.20. 39.20 is a very important gamma flip level, but we're coming right up into that 4,000 call wall after that. Unattractive risk reward, in my humble opinion, above that. So in the meantime, there's lots to unpack on your own, kind of take a look at this, but I can see a follow-up here that the dollar can continue to fall, yields can continue to fall. China hasn't turned soft yet, but that is one thing that I'm looking for. And I have a whole bunch of trend discussion, but I'm going to do that after the market opens.